Hey everyone, Mike, Greg, how you guys doing today?
Hey, Nick.
Good, good. Well, this is an exciting day, Mike. I'm really thrilled to have you here in the podcast. Today we have with us Michael Egan from First Trust Advisors LP, who has over 30 years of experience educating financial professionals and investors. Michael is also the author of Your Stronger Financial Future. Michael, welcome.
Thank you. Great to be here.
So I want to give you a quick overview of what today is going to look like. Greg's going to co-host with me today. We're going to ask Mike a whole bunch of questions, and we're going to dive into custom option solutions and direct indexing, and how that can help manage concentrated equity positions, seek to mitigate losses, and to create income opportunities.
So, Mike, it's great to have you here today. It's a great opportunity where your work's very important, and we're in a timely situation, and that we're near all-time highs or at all-time highs at this point.
So, Mike, I want to make the case for options here. Let's start with the big picture. Why are concentrated equity positions a growing concern for investors today?
Nick, I'm delighted to be here, and thank you for that question. I want to start off by saying that options and direct indexing strategies like those we're going to go through are not suitable for every client. The client really needs to talk to their CPA about tax ramifications, and then to their advisor, the two of you, about whether options or direct indexing are suitable for their investment objectives. Please note that when you use options, you can lose money. It's important to get those important criteria out of the way. So let me go back to your question, Nick. Why is now a time that investors, individual investors, family offices, high net worth individuals might really start considering mitigating some of the risk in or hedging in concentrated stocks or portfolios that don't match their investment objectives? I'm going to give you a few statistics, if I may. And I just happened to look this up this morning in preparation for the podcast. Would either of you want to guess what the May 27 of 2023 to yesterday, if you bought the S&P 500 in 2023, May 27, and held it to yesterday, what is the price appreciation? Not even including dividends. Will you give me a guess?
What do you got, Greg?
20%?
And for those of you listening, obviously we did not prepare this because that's not even close. 41.6%. Again, that doesn't include dividends. So any client who's held U.S. large cap stocks as relates to or tracks to the S&P 500 has experienced a huge appreciation. And isn't that great? That's what advisors are here for, is to grow your money thoughtfully and intentionally. But at the same time, we've now created a huge imbalance because advisors typically want to, for those clients who are trying to protect while growing their wealth, they want to have a reasonable asset allocation, a mix of large cap, small cap, mid cap, international, fixed income alternatives. And the market action in the last 2 years has completely screwed that up. So that's item number one. Item number two is what I'm going to call that air pocket we just went through. We all know from February 19th, when the S&P 500 was ever so slightly where it is today, about 58.99, to April 8th, when it closed at 4,830. Everybody remember that tariff-induced air pocket as the market kind of reacted to it? That was an 18% drop. That gets high net worth investors' attention. Do you want to go through that as an investor again, or would you like to have some type of hedge in place? The third item that I think is also really important, I'm going to ignore the Mag 7 because that's been discussed so much. We all know the outperformance of the Mag 7 versus the rest of the S&P over the most recent period, but that also over-concentrates the highest value stocks in the S&P. But here's a statistic I think is really important. Demographically, from 2024, last year, to 2026, next year, over 4 million Americans turn 65. We all know that's the magic age when we're supposed to retire. Whether that's appropriate for each individual investor is up to them and their advisors. But 4 million retirees per year, going from, hey, I'm okay with just growing my assets because I have W-2 wage income, to now I need those assets to be feeding me income because I don't have any anymore other than perhaps Social Security or a pension. That's a big change for a lot of investors, and probably wise for them to start considering, where are my risks in my portfolio and what steps can I take to mitigate those risks?
No, like that's great, and I think that's great insight to recognizing where where Americans are, where the working population is leading into retirement, and that sudden change that they made. It really doesn't get calculated for many of them until they're almost on top of it, of how serious that is. I mean, they've been saving for years. They've been doing what they need to do to try and build up their wealth long-term. But it really is quite the change. Like you said, going from working full-time to now I went from doing dollar cost averaging upward to now I'm doing dollar cost averaging in reverse. And, Mike, I heard in one of your other talks, I can't remember if it was in your book or another talk I heard you give, but you mentioned that households hold about 40% of U.S. corporate equity. What risks does this concentration pose, especially during market downturns?
Well, great question. That number is actually 37% as of the third quarter of last year. It's a number from the U.S. Federal Reserve. And think about that for a second. It's not 37%, it's $37 trillion is held by U.S. households in U.S. corporate equities. Typically, those assets are not advised on by their advisor. They're held away, meaning they're held in a brokerage account. They may be held with the underlying company's transfer agent. They may just be held in a certificate in a bank security deposit box. The challenge that I think many advisors face is they can't give advice. They can't incorporate those assets into a financial or estate plan if they can't see them, if they're not aware of them. That's on the advisor side. On the investor side, if you are holding an enormous amount relative to your net worth in one stock or in a portfolio that doesn't match your investment objectives, meaning you have way too many equities relative to an asset allocation that's reasonable according to your advisor, you're really amplifying the risk in your portfolio. And perhaps if you're in your 20s or early 30s, or even late 30s, perhaps that's not as bad because you have time to recover. If you're in your 50s or 60s, perhaps you're already retired, that risk could come back and bite you, just like we saw during that air pocket I referenced earlier this year.
Yeah, I mean, I think a lot of our clients have exposure in ESOPs and 401ks. And so we're looking at direct and indirect company stock exposure. I think that's what you're referring to.
Yes, thank you. That's exactly right. We hear from a number of advisors that, especially those clients who work for the company that has grown their net worth. In other words, they work for a public company. They might receive employer-issued compensation, equity compensation, like incentive stock options, non-qualified stock options, restricted stock units, stock appreciation rights, all wonderful equity compensation components of your entire net worth. But advisors will tell us that they beg their client, you have too much exposure to that company. You work there. You probably have common shares. Your entire livelihood depends on it. Please don't allocate your 401k to your company stock. And most investors or employees do that anyway because it feels like the right thing to do. You work there, you know the company, it's gone up, it's made your net worth what it is. But we also know as advisors that you build your net worth through concentration and you retain it through diversification.
That's good. Mike, I've also heard you share that around 30 to 40% of the S&P 500 constituents actually outperform the index. What does that imply for individual stockholders?
Yeah, thank you for that question. That number, I believe, is exactly 36%. And I'm going to check the dates, but I believe that's from Jan 1 of 1990 to the end of 2024. So 35 years of data. So the excellent point, 36% of the S&P 500, those stocks outperform the index. And that makes some intuitive mathematical sense, right? You have 50% that outperform generally and 50% that underperform. But in this case, it's just a little bit more than a third. There's a large percentage, I believe it's 26%, that over that time period, not only underperformed the S&P 500, but actually lost money. And here's the rub, right? You might think, okay, well, I don't really care as an investor as long as I own one of those 36%, which is terrific. But statistically, it's the odds are not good. Right? You have about 1 in 3 chance that your company is one of those. The other 2/3 of the time, you're underperforming the index, or you're underperforming and losing money. And of course, that really doesn't help your financial plan going forward.
So clients more concerned about protecting their gains. Just how do strategies like credit collars help to limit downside risk in those situations?
Yeah, thank you for that. Let's talk a little bit about how option strategies work. And again, it's important to note option strategies are not appropriate for every investor. You really need an advisory team that is skilled in explaining options and identifying whether they are suitable for your objectives. Let's talk about the 3 things that options can do. I'm going to limit my comments to equity options, but they apply to options on other underlying assets like bonds or commodities. Options can do 3 things. The first is that you can speculate with them, which we don't do at First Trust. We didn't do at any of my predecessor firms. The second is that you can sell options to earn income, whether you're selling calls, you're selling puts, you're selling, in that case, the right for the other side to do something to exercise against you by a certain point, which is the expiration date at the strike price of the option. So there's all the components. You have the strike price, expiration date, and who's the buyer, who's the seller. If the investor is the seller, then they're receiving a premium upfront and selling the right for the other side to do something, whether to take your stock away in terms of a call or sell their stock to you in terms of a put. Our comments today really won't be in terms of selling puts. This is going to be just in terms of selling calls. So you're selling the upside, if you will, above the strike price. If your stock hits that strike price, it can be called away if you don't close the option prior. Okay, well, that provides us income, which can be quite useful for a number of investors' portfolios, whether it's concentrated stock or a portfolio that doesn't match their investment objectives. How do we protect on the downside or mitigate or hedge the risk? We do that by buying a put option. In this case, the investor is paying a premium to a seller for the right to sell that stock back to the seller at some point when it drops below a certain strike price or particular dollar amount. So let me use an example here with numbers. If I start with a $100 stock price and I buy a put option that's struck at $80, that would be a 20% maximum downside between 180. Then if the stock goes down anywhere between 180, nothing happens. Very analogous to other property casualty insurance policies where if you don't meet your deductible, the insurance doesn't really kick in. Below 80, in my example, if the stock were to go below 80, let's call it 78, that put option has value. In my simple example, it's $2 per share, the strike price of 80, down to 78 or $2 a share. More importantly, that is hedging or mitigating risk from $80 down to 0. So effectively, you're hedging 4/5 of the client's risk. You can write a check for that. I'll admit most investors really prefer not to do that. The more volatile the stock, the more expensive that protection, or excuse me, that hedge gets. Instead, they like to sell, as I mentioned, a covered call. Covered meaning that they own the underlying security. And as an example, if we have 20% downside or an 80% put, again, mythical $100 stock, and we're selling a $120 call or ceiling or cap, then in our slang, that would mean 80, 120 in terms of percentages. If the income from selling the cap at 120 or the call option exactly offsets the cost or the premium you pay out for the put option, that is a cashless collar. It's important to note, it's not free. Even though the two cash flows are offsetting, and they can be offset literally to the penny, they can even be structured so that the call option is set ever so slightly lower, so it generates a little bit more than is required by the put. The term for that is a credit collar. I like to think of that extra as surplus or excess. And of course, the client or investor can use that for anything he or she wishes. They can pay part of their advisory fee, they can spend the income, they can do as they wish. It's cash in their account. But the combination of a collar, noting that it's not free, what did we just accomplish here? Well, we took a volatile asset. Perhaps it's way too much of a client's underlying portfolio. We've seen clients with 80 or 90% of their entire net worth in one stock. Typically, they work there or they sold their private business for public stock. And congratulations, success stories. But boy, we've also seen some horror stories where those stocks don't perform as expected or go straight down. And that obviously ruins the client's financial estate plan.
Mike, you mentioned an interesting point there. The danger of, and what that comes down to is, like you said, they were successful. They picked the stock, they stuck with it. I know a number of people that did that, and they made out fabulously doing that. But then you get to a place of pure necessity of there's enough money there for them to live. How should the next generation handle receiving that stock? Because for so many of them, it's such an emotionally tied investment. What advice would you give to the inheritors of, a mom and dad who owned Apple stock for 30, 40 years, and it's worth millions of dollars, and they're receiving this? Those emotions are attached to the parents. How would you help them address that?
We do encounter the inheritance quite often. It's actually occurring more and more often. We all know the statistics, the demographics, the baby boom transferring their assets down to the next generation, the greatest generation transferring them down. And what we see almost 100% of the time is there is one child or grandchild who is called the steward, who probably missed the family meeting and was determined that he or she was going to be in charge of this risk. And they're terrified because grandpa started a company or mom worked for a company, and they said, don't ever sell a share of that stock. But boy, that's even making it worse, right? Because now it is owned by not just the first generation, the decision maker, the creator of the wealth. Now it's owned by a trust, ideally, or it's owned in joint name among several different siblings or several different trusts. And you typically have one child or grandchild that's in charge. And what do? Often they want to say, let's take some of it out and let's distribute the income. And we can't get into trust and estate planning here. Again, I would suggest you go back to Nick and Greg and your advisory team, including your attorney and your CPA, to identify the most effective way to mitigate taxes. But boy, on day one, as soon as you are in charge of that asset, talk to your advisor about whether a collar strategy works, even for the short term, right? Back to my mythical $100 stock, 81.20. Boy, wouldn't it be terrific to have hedged or mitigated that risk, even for just a very short period of time? Let's call it 3 to 6 months, while you're exhaling, while you're digesting all the responsibility that now has been put upon you as the trustee of that particular asset.
That's great advice, Mike. Thanks for that feedback.
So how do we lead that into direct indexing?
Oh boy, big question. Let's start with what direct indexing is and what it can do. First, I would suggest if you're an investor listening to this, talk to Nick and Greg, talk to your CPA about whether direct indexing works in your portfolio. Direct indexing is effectively the unbundling of an index. Think of the S&P 500. Strangely, there are 503 names, individual stocks in the S&P 500, but that's a story for another podcast, perhaps. Let's just assume it's 500. A direct indexing strategy, as opposed to a package strategy like an ETF or an index fund, where you can buy the return of that index by just having one line on a mutual fund or an exchange-traded fund. The challenge with that from a tax perspective is you can't unbundle it. The only way to mitigate any taxes is to have a loss in that particular ETF or mutual fund and then sell the whole thing. You can't sell a little piece of it or one portion of it. And as we just went through a few minutes ago, the S&P 500 is up over 40% over the last 2 years. So the chances of any investor having a loss in an index fund is pretty low, especially U.S. large cap equities. So how do I unbundle it? Well, I open a separately managed account, meaning that the investor actually sees all of the stocks in his or her portfolio. And through the use of an optimizer, a direct indexing strategy purchases a subset of the particular index. Let's talk about the S&P 500. We can identify approximately 125 or 1/4 of the number of stocks in the S&P 500 that will result in an investment return which is very, very tight to the actual S&P 500 itself. We call that tightness, if you will, or that dispersion. We call that tracking error. Tracking error is just the how much more or how much less could I expect over a reasonable amount of years versus the S&P 500. So it is an example, if I have a 0.5% tracking error and the index is up 10%, that means my portfolio 2/3 of the time, or the majority of the time, is going to be between 9.5% and 10.5%. So I would argue that's pretty tight dispersion, 0.5%. Okay, so wait a minute. If we're just going to replace the return of an ETF that's linked to the S&P, we didn't really accomplish anything. Here's the second part that is the most exciting. Because we own individual securities in the portfolio, every time there is a price decline in any of the stocks, the 125 in my example, stock goes down 2%, as an example, for any number of good reasons. Back to the air pocket, we had the entire index down 18%. But suppose a particular company announces earnings which don't quite match the market's expectation. It sells off 2% right at the open. Well, in direct indexing, our optimizer will identify for our traders a potential sale of that stock. Let's call it Coca-Cola. Coca-Cola is down 2%. We sell that, we take the 2% tax loss, and we buy a substantially identical security. Not the identical security, but a substantially similar security like Pepsi. What did we just accomplish? We took a 2% loss and we own a stock which will perform like the stock we just sold. So the portfolio, the entire account, still mimics, in our example, the S&P 500 within that tight dispersion. If Home Depot is down, we might sell Home Depot and buy Lowe's. If Ford is down, we might sell Ford and buy GM. You get the idea. We're selling securities we already own, 125, and taking the pool of the other 375 securities to identify a substantially similar security. We only execute a sale under 3 criteria. Number one, it has to have a meaningful loss. We're not going to do something to take a $10 loss in a $1 million account. Number two, what we're doing has to not injure the tracking error. Or in other words, we have to have a place to go. And sort of as a third bullet point on that, the wash sale rule, which is something you should discuss with your advisor and your CPA, is 31 days. We don't want to violate the wash sale rule because then that tax loss we thought we took, we can't actually benefit from. So those are the 3 criteria. Pretty straightforward so far. You can index, or you can identify a benchmark like the S&P 500, but also EFA, which is Europe, Asia, and the Far East. It's typically used by advisors for foreign investment. You can have essentially any conceivable equity index. There are 70 of them on the First Trust platform that you can identify as the benchmark you want your return to mimic. So your advisors, like Greg and Nick, can identify that part of your asset allocation that perhaps isn't as high as it should be. Typically for high net worth investors, that's small cap and mid cap in the US because everybody owns too much large cap, as we've talked about. You can also toggle. I like to think of it as a toggle switch or a lever, where if I have as an investor, a particular view or a particular industry that I want to stay out of. What if I own an enormous amount of one particular stock in the IT sector? Well, I might want to remove the IT sector from my direct indexing account because I have enough exposure to it. What if I am a proponent of ESG? I can identify that. What if I am not interested in ESG? I can identify that as well. You can have faith-based. The largest faith-based we see at First Trust are Baptist and Roman Catholic. Catholic, for example, that account would be invested according to the US CCP guidelines. So we wouldn't buy or sell a stock that's not on that list. So it allows for a toggle switch customization, if I can call it that, or a lever. And it is designed to create or to harvest tax losses while adhering to a very tight dispersion around a chosen benchmark. Greg, that was a lot of me talking, so I want to make sure I pause there and let you direct me differently.
So direct indexing is certainly not new. Can you talk a little bit about why direct indexing is coming up on the radar today compared to, say, 30 years ago when it started?
Yes, direct indexing is not new. It's been used by institutions for at least 30 years. There's no record of the first direct indexing account, but we've known about this for many, many years. The problem was for individual or retail investors, the friction in trading in and out of those stocks, Coke for Pepsi, Home Depot for Lowe's, et cetera, that costs too much money and would basically eradicate or eliminate the tax benefit by the time you paid the commission on both sides. Well, we all remember that day, I think it was about 7 years ago, when both Schwab and Fidelity said in the same week, hey, by the way, no more commissions on equities. And we were all surprised in the industry for about a week. And then we said, wait a minute, if there are no commissions, now we can use direct indexing for individual clients and for effectively non-qualified or taxable accounts. There's no trick to this. There's no change in the tax code that we're aware of. Again, ask your CPA, but this is simply tax loss harvesting done intentionally, carefully, and methodically.
That's great, Mike. It's really wonderful to hear that there are tools out there like this that can help our clients and help them make more complex financial decisions on, do I hold on to this stock? Is it right for me to continue to hold on to it? Because like you said earlier, there's this emotional tie to hanging on to something, and you're able to break it down and utilize your strategies in such a way that it allows them to still keep it, but allows them to diversify away from it to receive income, simply create greater diversification, which ultimately all those things tailored to a specific person and their specific solution should ultimately bring them long-term financial success. That's great stuff, Mike. Greg, do you have any other questions on that line that you want to ask?
Yeah, so one of the things that I think, because of the democratization of wealth management and direct indexing going down to the level where a lot of people are showing up on the radar now, can you kind of talk about the different ways that companies do direct indexing? So there's the ability to differentiate between direct indexing light, I call it, and direct indexing in a way that that's very more aggressive, and we're gaining more losses and pushing them forward. And maybe just talk about even how far we can push them forward. A little bit of tax details of where direct indexing applies today. We can do things we couldn't do before.
Sure. And back to Nick's comment, talk to your CPA, talk to your advisor before you engage in any of this. But Greg, your question is really important, as direct indexing has grown and has become available not only to advisors, but obviously to their individual clients. It's growing very quickly. In fact, it's one of the fastest growing strategies for individual investors in the country, quite frankly, because of all the things we talked about. You can realize the return of a benchmark or an index, and you can be quite tax efficient along the way. Some of the competitors out there, or some of the providers of direct indexing, say, that 31-day wash sale rule, we've got a way we can be sure we're never going to violate it. We'll just run the optimizer once every 31 days. And of course, that math is accurate. But think about back to that air pocket. Let me get the dates exactly right here. The top of the market was February 19th until today. As you mentioned, Greg, we're back up there. The bottom of the market was April 8th. So imagine you're an individual investor or you're an advisor who has engaged in direct indexing, and your client calls you and says, hey, I remember that direct indexing tax loss harvesting thing. The market's way down for various reasons. How much did we take in losses? And the advisor says, well, you were only running that every 31 days. Nothing. We didn't take any losses. I'm going to contrast that with a different conversation. The investor may say, hey, I'm invested with First Trust, and they run their optimizer continuously. Every second that the equity market is open, the optimizer is searching for opportunities to take losses. Again, it's going to present those three opportunities. Only if the opportunity matches those three criteria will the transaction be shown to our portfolio managers, meaning we can't violate the wash sale rule. It has to be meaningful. We have to have a substitute security to get in there, which won't injure the tracking error. But imagine the amount of, or the number of those opportunities even just over a calendar week, 5 trading days from 9:30 in the morning Eastern to 4 o'clock Eastern, every second that the market's open, the answer to the investor's question during that air pocket, hey, did we take any losses? The answer is yes, we did. And you can see it in your portal. Advisors tell us that this is where individual investors actually start to engage. For those individual investors out there, I would say, please listen to your advisor. They are telling you what is best for your portfolio and your objectives. But investors will say, hey, I looked at my account and I could see in the portal or the way I access my information that, boy, we've taken these short-term losses and now I can pair them, as Nick said, versus those long-term gains. So my large cap stocks are up over 40% over the last 2 years, and I just really don't want to rebalance and pay taxes. But in the direct indexing portfolio, I've realized some meaningful losses. Now I can sell some of the original problem and match it with the losses and approach tax neutrality.
And you can carry them forward for how long?
I'll defer to what CPAs tell us, which is forever.
Okay. So I want to go a little deeper on that. So when we look at, when a client looks at it and says, okay, like a year like last year, okay, the market was up a lot. You know, it had some ups and downs, but it was up a lot, especially if you're looking at an index. So a direct index or an ETF of an index. Talk about the opportunities owning individual positions, tracking them, like you said, minute by minute as the market is open. How's that differentiate between one direct index where it's going to be way less focused on each individual position and a year that's up and it looks like it was just an all up year or mostly up year? What opportunities are there in that difference?
It's intuitive as an investor to say, hey, 2022, the market was way down. Kind of easier to take those tax losses versus a year like 24, as you're asking. That's correct. However, in any of those years, 74% of the S&P 500 components were down 5% or more at one point or another during the year. 5% or more, 75% of them. That means 25% were not. I get that. But if there's that opportunity, because the optimizer is running continuously to access that 5%, even in an up year, we can still harvest tax losses. So this is kind of the opposite of a mutual fund, right? Where a mutual fund, you might invest halfway through the year, the manager's already taken gains, which you're going to receive as a 1099 at the end of the year. And you could lose money after you invest. So you have kind of the worst of both worlds, right? Where you lost actual money and you still got a tax bill. Flip that around with direct indexing where you could make money like you did last year and still end up with a 1099 that shows a loss.
Okay, I'm going to go one more. You talked about the Coke and the Pepsi. So I want to talk about technology and part of the modernization of wealth. Let's talk about something doesn't mirror it exactly. So we're in a stock that doesn't have one particular stock. How does the technology work? Do we slice several different stocks to put together? How does that work? To put together the buy and the switch?
You know, that's a great question. And when you use an index like the S&P 500, as we all know, NVIDIA is an outsized contributor both up and down to the S&P 500's price return. There really isn't a competitor to NVIDIA. So if an investor invests in an S&P 500 direct indexing strategy, you're going to own the Mag 7. And it's very challenging because of the structure of the S&P to mitigate the risk of those top stocks. So it's really I'd call it the other 450 or the other 493 stocks that are going to provide those losses or potential for tax loss harvesting is what I meant.
Makes sense. Mike, just circling back to something you mentioned earlier, you have decades of market cycle experience. What's one key mindset shift you would recommend for clients who have a lot of emotion tied up in one or two stocks?
Well, the easy answer is stop being human. But nobody does that, myself included. It's really hard when the market's going up and your net worth is going up. It's easy to look at your statement. I come home about the 15th of each month from work, and my wife has received the statement in the mail. We've been married for a long time, and she does this every month. She'll open it up, and she'll look at last month versus this month and say, you're doing a great job, or what happened? It's one of those two, right? She doesn't look past page 2, or page 1, excuse me. that's normal, right? I expect that a lot of investors here are probably smiling and kind of laughing to themselves. And you might be the person who does that to your spouse or to your partner. When it's going up, we all know it's a good idea potentially to take some of that risk off the table. In the United States, especially, we make money through concentration. We keep it through diversification. And Greg and Nick, I'm sure you tell your investors as often as they will let you, let's diversify. So an investor listening to this, I would ask, please don't start shaking your head when Nick and Greg say, let's diversify. Perhaps think about it as a very long-term diversification strategy. So give me an example. If you have more than 20% of your net worth in a single security or a tiny basket of securities, would you consider selling 5% a year for the next 20 years? Right? That doesn't hurt very much. Often your securities are going to rise more than that on an annual basis, so you really won't have less in terms of absolute dollars in that stock. But what you'll be doing is slowly peeling off. We call this dollar cost averaging, as Nick mentioned on the way out. Along the way, though, I would suggest, remember that collar example years, 80% put, 120% call. Let's look at, where appropriate, employing collar on that concentrated stock. So while you're waiting to sell that 5% per year over many years, some portion, maybe it's half, maybe it's the entirety of your portfolio, is hedged. And that way, if there is disaster in that company or a disaster in the US stock market, it's less of a problem for you.
That makes sense. Mike, thanks so much for your insights today. Greg, your questions, they were great. Hopefully those listening learned a little bit about direct indexing, how it might possibly apply to you. I want to encourage you to reach out if you want to talk about it further. Mike, for the listeners, where can they find your book, Your Stronger Financial Future?
I believe it's still on Amazon. As I like to say, it makes a great holiday gift.
Well, Mike, thanks again to Universe Trust for your time today. Look forward to connecting again in the future and having more of these discussions.
Thanks, guys. Good to see you.
Yeah, take care.